In a previous video, we talked about liquidity. And in that video, I said there are three things that you need in order for your business to be considered a financial success. In my opinion, there are three things that you need. This is the three-legged stool that I tell my students that they should try to be resting their business upon. The first one is profit. You need profit in order to profitably run the business, so you got to have some profit. Second thing is you need to be liquid, and the third thing is you need to be solvent. Today we're going to look at some measures of solvency. Now we're going to look at the debt to equity ratio, and we're going to look at two other ratios that are very similar to the debt to equity ratio. So the thing that's important to note is for our solvency ratios, we're looking at total liability, total equity, total assets. Whereas before, when we talked about liquidity, we were looking at our current liabilities and various types of current assets. So solvency is a long-term thing. Solvency says, hey, if we had to shut the business down and sell off all the assets, that is, liquidate the business, would there be enough left over to cover all the liabilities? Whereas liquidity is a way of looking at, do I have enough to cover my intermediate or short-term liabilities so I can stay in business just a little bit longer? So to summarize, you need profitability, you need liquidity, you need solvency. So that's an important thing to always remember. We're also going to look at a thing called the times interest earned ratio. And so this is the income before taxes plus our interest expense divided by the interest expense. And it's a way of quantifying how much of our profit is being burned up paying interest on our debt. Let's head over to the spreadsheet where I've created a little bitty worksheet so we can talk about solvency. Now, another word that pops up here is the word leverage. So leverage is a word that we use when we want to try to describe how we're using our debt and our assets in order to build our equity. So if you have a lot of leverage, it means you have a lot of debt. That's the thing to kind of keep in mind. We think of debt as leverage. And the thing to remember about leverage is leverage brings risk. The more leverage that you use, the more risk that you have. And that's always an important thing to keep in mind. So I've just listed the assets, liabilities, and equity from our balance sheet for the 2 years that we're looking at, 2030 and 2031. And I started off by calculating the debt to equity ratio. We sometimes hear this called the leverage ratio. Now, be careful with our terminology because I have seen other sources call something else a leverage ratio, and we always have to remember that. When we ask, hey, what's the leverage ratio? Well, let's ask which leverage ratio you're calculating, because you can almost call all of these things leverage ratios. And that's because these three things we're going to calculate here, once you know one of them, you can always back out the others. And that's a little bit tricky and probably for a video for another day. But for now, we're just going to calculate them. Now, the debt to equity ratio, we're going to call that the leverage ratio in this case, is just the debt, which would be our liabilities, divided by our equity. So let's highlight the formula. It's just the liability number of 19.75 million divided by the equity number of 17.25 million. Hit enter and we get a number 1.15. Well, what that means is that our debt is more than our equity. Our liabilities are larger than our equity. And that's generally viewed to be a bad thing, but we have to remember we also have assets, right? So it's not necessarily the end of the world. As that number gets larger, the business has more leverage and the business is riskier. As that number gets larger, the banks are less excited about loaning the business money. If you're already leveraged to the hilt, banks don't want you to become more leveraged because leverage means risk. Now, it's pretty normal for someone to argue in a finance class that you have to have leverage in order to have growth. We're going to talk about that later when we talk about DuPont Analysis. That's an important component of that analysis. So maybe you need a lot of leverage so you can grow. And if you did this calculation and you got a very big number, 4 or something like that, that might tell us that perhaps we are attempting to grow and we've gone out and borrowed a bunch of money so we could grow, and maybe we need to stop borrowing money and execute on that growth. In this particular business, 1 year later, we see that the debt to equity ratio, the leverage ratio, is 0.95. So now our liabilities are less than our equity. This is a business that's not leveraged and therefore is not exposed to that risk from being leveraged. Now, the next two things, the debt to asset ratio and the equity to asset ratio. The equity to asset ratio is sometimes called the capitalization ratio because it tells us to what degree the firm is capitalized by equity. In other words, we're asking how much of our capital in the business is coming from equity or investments from owners as opposed to debt. Now, these two numbers must always be less than 1. They cannot be greater than 1. It's a mathematical impossibility. And in fact, the two numbers, the debt to asset ratio and the equity to asset ratio, will always sum to 1. So if you know the debt to asset ratio, you default know the equity to asset ratio because they always sum to 1. That's a side effect of the fundamental accounting identity. Again, we'll probably need to do another video kind of showing how all that works. So what do you want? Do you want a big number? Do you want a small number? Well, the better way of thinking about that is looking at this from a standpoint of how much of my assets are claimed by me, the owner of the business, or the stockholders of the business, and how much of the assets are claimed by the people we owe money to. So from that standpoint, you want more equity for your stockholders. So you probably want that equity to asset ratio to grow over time, to become a bigger number, to become closer to 1. This is saying that 53% of the assets in the business are owned by people who we owe money to. So the people that we've borrowed the money from have a claim to 53% of our assets. And we, as the business owners, only have a claim to 47% of the assets. And over time, what has happened? The next year, the people we owe money to only have a claim on 49% of our assets, and we have a claim on 51% of our assets. So over time, we've moved in what I would consider the right direction, meaning we become more solvent and our assets are making money for the owners of the business, not the people we borrowed the money from, not the bank, right? That's the way to think about it. The next thing is the times interest earned ratio. So the times interest earned ratio measures the risk of the business not meeting its interest payments on its loans. It's going to compare the size of the organization's pre-tax earnings relative to the loan interest due during the period. Now, this one is interesting because this is the first of our measures that we actually don't pull off of the balance sheet. This is coming off of the profit and loss statement. Maybe we call it the income statement, right? So what we have is we have the income before taxes plus the interest expense, all that summed up and then divided by the interest expense. So this is one of those things when it's really kind of important to compare things. We look at the profit went up and the interest expense went down. So we're burning less money paying interest and we're making more money. And in time, that number has gone up. So this is one of those things where you want that number to climb over time. So as that number's going up, the business is going to be in a stronger financial position. Now, before we leave our solvency and leverage ratios, I want to talk briefly about a thing called DuPont Analysis. And in DuPont Analysis, we take our assets and divide it by equity to get the asset to equity ratio, which is the inverse of the equity to asset ratio that we covered here, the capitalization ratio, the inverse of that. Now, I have seen some sources call this the leverage ratio. It is the leverage ratio that you use in the DuPont analysis. I've also seen it called an equity multiplier. So whenever you're stumbling across these various ways to use these various solvency and leverage tools, make sure you look close to see how it's being calculated so you understand what's going on. You're going to get a different number and a different explanation behind that number. We'll do a whole video on the DuPont analysis at some point in the future. sure you hit subscribe if you want to catch the next update whenever it comes out. And if you like the video, hey, like the video. If you found it useful, if you found the information easy to understand, let me know. And you know what? The comments section is wide open. If you have any questions, feel free to ask in the comments. Please keep in mind that I don't have a degree in accounting. I'm not an accountant. And teaching you to be an accountant is not my goal. My goal here is to help you kind of understand the types of things that accountants look at. So let's go ahead and wrap the video up, and then we'll move on to our activity ratios in the next video.